Hi, this is David Abonic Turtle, continuing with the focus on CFA and today earnings per share. So earnings per share is important into accrued valuation that I've illustrated here. If we have earnings per share and we multiply by the PE multiple, and the PE multiple is itself just a ratio, price divided by earnings per share, then we get the share price. And so typically we have the EPS observed and the price observed, and so we infer or extract the PE multiple. Before I illustrate the earnings per share measure, I'd just like to remind that it's just another ratio that we could look at. Here's the general form of that class of ratios. So earnings per share is just one of these, where in the numerator we've got an income statement measure, in this case net income, and we've got a balance sheet measure, in this case common shares outstanding. So just to illustrate the earnings per share, I want to show you both measures. I've got here a real simplified income statement that would have the top line, sales or revenue, here at the top. I've omitted those numbers. And then the company would deduct expenses on an accrual, not a cash basis. And it would get down here to incomes or earning before taxes, EBT. Then there would be a provision for taxes, again on an accrual basis. If we deducted that, we would get the company's bottom line. It's popularly called the bottom line. This could be on an annual or quarterly basis. And technically, that's the net income on an accrual basis. Now, I've also assumed this company has some preferred shareholders and it pays a dividend to them. In terms of the balance sheet here, just a quick assumption that the company started the year with 1 million common shares outstanding, and then on October 1st, issued an additional 400,000 shares. Maybe they raised some additional capital from equity shareholders. And so on October 1st, the common shares grew to 1.4 million. What we want in the denominator of earnings per share is weighted average common shares outstanding. So here we have 1 million for the first 9 months, and then we have 1.4 million for the final 3 months of the year. That means on a weighted average basis, we have 1.1 million weighted average common shares outstanding. That's what we want in the denominator. And so basic EPS, I'm going to move my window over here. Basic EPS, you can see, is a straightforward calculation here where we take the net income of 2.5 million, subtract any preferred dividends. In this case, I've assumed 200,000. So that's my numerator, and I divide that by the weighted average common shares outstanding. So you can see that's the calculation, that's just the ratio, and I get $2.09. And this is called basic EPS because this is the first flavor of EPS. And the idea with basic EPS is we're assuming the simple capital structure, really. That is to say, a simple capital structure is when we just have debt and equity. So basic EPS here is just concerned with the claim that the existing common shareholders have on the net income. But they're not going to get the preferred dividends, so that needs to be subtracted out. So you can see here basic is net income divided by weighted average common shares outstanding. And it's basic because it's on this view of the simple capital structure, only the common equity. So now let me look at diluted EPS, the other flavor here. I've got the same assumptions here for the company's net income, and now I'm going to recognize that the company has a complex capital structure. What do I mean by that? All I mean is instead of just debt and equity, we've got a hybrid class, so that could include convertible debt, convertible preferred. The other reason why most public companies have complex capital structures is because it also includes employee or executive stock options. Because after all, until they are exercised, they are not common shares, but they can be exercised into common shares. And so what do we do about that? Well, that's why we have the diluted earnings per share look. That's because we like to look at the claim on net income, but under the worst case assumption, if these hybrid instruments were actually converted into equity, which generally amounts to dilution for the common shareholders. And so the diluted EPS has the same numerator, but notice in the denominator that we take weighted average common shares outstanding and we add the net shares. This would be the additional dilution if these hybrid instruments if their dilution impact would be realized. So to illustrate that, I'm just taking the options, the example of the options, and assuming this company has 30,000 stock options outstanding, so these are employee stock options, with an average option exercise price of $35. And let's say during the year the company's market stock price is $55. So we've got option exercise price on average, and then we've got the market stock price at $55. So on average, most of these options held by employees are above water, not underwater. And then we just diluted EPS performs the exercise that asks the question, well, what if the worst case dilution scenario was realized and all of these options were immediately exercised? Well, first of all, they have to pay the $35 per option, and that means the company would receive cash of, in this case, 30,000 times $35, or $1,050,000 in option proceeds. That's cash. So that's new cash coming in, and what we assume is the company takes that cash and repurchases shares, conducts a share repurchase in order to offset the dilution. How many shares would that purchase? Well, that's 1,050,000 into the average market stock price of $55. That would allow the company to buy back 19,000 shares. And so what's the net share dilution under an if converted basis? Well, it's the 30,000 options that would be newly created if those options were exercised. However, the cash proceeds would allow the company to repurchase 19,000 shares. So it's not the full 30,000 in dilution, but a net dilution or net additional shares of 10,909. And so that's the theory here behind the net shares if converted. Under these assumptions, those options, if they were all hypothetically exercised, remember this whole thing is just a mathematical exercise the company performs to just immediately calculate the instantaneous dilution impact if those hybrids were converted. And so in this case, those 30,000 in options would represent additional dilution of 10.9 thousand shares, giving us, we add those to that weighted average common shares outstanding, and we will get a larger number, in this case, the diluted common shares of 1,110,909 diluted common shares. And so now the diluted EPS takes that same numerator as before and instead divides it by this larger diluted common shares denominator, and that means we're going to get a lower number. So we're always going to get a lower number on diluted EPS than basic EPS if there are any hybrid instruments on the balance sheet or in the capital structure that could represent potential dilution. So here I get the $2.07. And so one thing as an analyst you can do is compare the two just to see, as a rough gauge for the amount of potential dilution that hybrid class represents. So that's Introduction to Earnings Per Share. This is David Harper, the Bionic Turtle. Thanks for your time.